Hello everybody, welcome back to my channel where we talk all things finance and investing. Today's video, I'm going to cover the topic of hedge funds. They get a fair amount of press these days, and in fact just this morning I was reading an article where it stated that hedge funds in the US have gone short the US market to the tune of many billions of dollars, which is effectively a bet against the US stock market and the US economy. Thought it was pretty interesting, so we're going to tackle it in today's video. Hedge funds, let's get into it. So first off, what is a hedge fund? You probably have heard me talk a lot about exchange traded funds, a little bit about mutual funds and some index funds, but what about hedge funds? I did a video on this a few months ago. I'll put a link into the description on the different types of funds, but let's go a little bit deeper into hedge funds today. So what is a hedge fund? Well, let's break it down. So first of all, in the name, you've got hedge and you've got a fund. A hedge is really just some sort of protection. You probably heard the saying before, to hedge your bets. Well, it's not really any different in this case. So think of it in terms of protection, and then a fund is really just a pool of money. So what a hedge fund will actually do is they'll take the pool of money and they'll look to invest it. Now, the more traditional way of investing in the stock market was people buying individual stocks themselves or investing in a fund where the fund manager would then buy shares of companies that they like best with the view of them going up. But this all changed with the invention of hedge funds. With a hedge fund, they don't have to bet that the stock market is going to go up, what's known as a long-only strategy, thinking that the market will go up. In fact, the mandate of a hedge fund is really to make money irregardless of any market conditions, wherever they see the opportunities. So therefore, they can get into more complex strategies, more complex products, with a view and a mandate of just simply making money every year, regardless of the conditions in the market. So one of the ways that they will do that, besides buying shares of companies that they think are going to do well, they will also take chances when they see the opportunity from profit from an upcoming fall in a company's share price, also known as going short. So how does that work, going short? Well, with going short, what a hedge fund or an individual will do if they're doing it on their own account, what they'll do is the hedge fund, for example, will actually go to their broker, known as a prime broker, whereas you and I would use a discount broker. They use a prime broker, and the prime broker will have an inventory of shares on hand. And the hedge fund will just ask them to borrow a particular company stock, one that they think is going to go down. So let's say the stock is trading at $100. They think it's going to go down to $50. They'll ring up their prime broker, ask if they can borrow X amount of millions of dollars of that stock. They will take that stock, pay interest on it to their prime broker, but they will take it and they will just click and sell it into the market. And they will now have an open short position. So now they're hoping that the value of that share price comes down 90, 80, 70, whatever. And at some point they will buy it back at a lower price. So let's say they buy it back at $50 a share, and then they return that same number of shares back to the bank. And the difference in that, selling at 100, buying back at 50, is their profit. And that's how hedge funds and other individuals, to be fair, will actually go short on the market. Now, they don't always just have to do shares as well. They can do things like commodities or Forex or all sorts of really funky things. They certainly did it in the collapse of the economy in 2008 with things like credit default swaps and other types of complex instruments. So they can get into really complex products. For that reason, hedge funds are not really available to the everyday person like you or I. They have high minimum requirements to invest hundreds of thousands, if not millions, before you're allowed to invest in them. And there's all sorts of rules and regulations that prevent people like you and I from investing in them. Now, to be fair, I don't think we're really missing out on all that much, to be honest. Why? Because the fee structure around hedge funds is incredibly high. And how do their fee structure actually work? Well, the way hedge funds do this is they actually take a percentage of the assets that they have under management. So if you're running a hedge fund, let's say that's got $1 billion in it, they're going to take between 1 to 2% of that just in a management fee. Then what they do is they will take a percentage of the profits that they make on any given year. So if the fund is up 20%, it's not uncommon for the hedge fund to take 2% of that as fees as well. And there are certain restrictions around that called high water marks or low water marks. So they have to hit a certain amount before that performance fee kicks in. But in a nutshell, they're very expensive. It's known as a 2 and 20 structure. 2% of assets under management and 20% of profits that they make. So in a lot of cases, hedge fund managers have become billionaires, and that's probably why they get quoted so much in the press. Think the likes of Bill Ackman, for example, or Ken Griffin with Citadel. A lot are very well known, and what they do gets mentioned a lot. So is it alarming that hedge funds at the moment have gone so short on the US stock market? Well, the reality is hedge funds over time have not really necessarily outperformed. There have been many instances where they've gone short, maybe on a particular company or on the economy overall, and it hasn't worked out. The most obvious example of this absolutely is Tesla. Back in the day, Elon Musk and the short sellers on Wall Street, mainly hedge funds, had absolute huge conflicts around this. Of course, they were betting that Tesla wouldn't make it and it would go bankrupt. And look at how that one ended. So for that reason, and many others, the fees in particular, the lack of transparency, and just the ability to invest in them, I don't think investors like you and I are really missing out on anything. It's worthwhile seeing what they do, for sure. They're employing some really smart people, big research departments and teams and analysts, and they're trying to constantly outperform the market, but they don't always do it. As you know, if you've watched my channel many times, you probably have seen, I think you're better off just using an S&P 500 index fund. Indeed, Warren Buffett once had a bet where he would bet $1 million for charity up against $1 million by any hedge fund that was willing to take him on, and he would only invest that $1 million in the S&P 500, and they can invest in whatever strategy they wanted, long, short, anything. And the idea was that after a 10-year period, whoever won, as in the increase in that $1 million bet, would win the bet and all the money would go to charity. Perhaps unsurprisingly, Warren Buffett absolutely won this bet simply by investing in the S&P 500. Why? The hedge fund was not able to outperform the market, which of course is very difficult to outperform the market. They weren't able to do it. And two, the fees were so high that made it prohibitive as well. So in the end, Warren Buffett won out. So my point is really, when it comes to hedge funds, you may think you're missing out a little bit here, but in reality, you're just not. You can continue to use your discount broker and invest in low-cost index funds, ETFs, anything like that. But if you really wanted to get involved, how could you actually do it? Well, there's actually an ETF that tracks some of the biggest holdings of the major hedge funds around the world. The ticker symbol is GURU, G-U-R-U. This isn't an investment recommendation at all. You might be restricted from entering this if you're based in the UK or Europe, but if you have access to US ETFs, then GURU might be one that you could look at. But as I said, not an investment recommendation, but just something you could think about if you wanted to get some exposure to these types of companies that hedge funds like to invest in. So that's my video on hedge funds. If you liked the video, why not click that like button? Subscribe to my channel for more videos like this. Really helps me out and grow. And I recently did a video on my one fund portfolio. So if you want to see what I do in my portfolio with only one fund, then click on this video right up here, and I'll see you over there and wish you all the best in your savings and investment journey.